On February 28, 2026, gold surged from $5,100 to over $5,300 in a single session. Today, it trades at $5,090. Every dollar of that war premium gone. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold has fully reversed its conflict spike while the war is still active. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now, subscribe to OG John AG 1.0, and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: the U.S.-Iran conflict and the Federal Reserve. February 28, 2026. Coordinated U.S. and Israeli strikes on Iranian targets. Gold futures spike over 2% in one session. $5,100 to $5,300. That is the fastest single-session safe haven repricing of this entire bull cycle. Today, March 13th, gold sits at $5,092. The war has not ended. Tehran is issuing defiant statements as of this morning. Washington has not signaled de-escalation, and the price has given back every single dollar of that war bid. The timing is what deserves scrutiny, not the reversal itself. The timing, a conflict that is still active, a strait that is still disrupted, and a war premium that has fully unwound. Think about what that sequence actually means. The answer is not that gold is weak. The answer is that three simultaneous mechanical forces are suppressing the price while the structural bid remains intact underneath. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time the DXY held above 100 during an active Middle East supply shock, gold consolidated for 6 weeks, then broke to new highs when the dollar's war premium reversed. The data is already telling you something. Let's build it out. Now let's build the full picture, because this war premium reversal does not exist in a vacuum. The ICE US Dollar Index, DXY, is printing 100.17 on March 13th, up 0.44% on the session. That is its second consecutive weekly gain. The U.S. Treasury Department's official daily yield curve has the 10-year at 4.24% as of Thursday's close, a 5-week high. The CME FedWatch tool is pricing a hold at the March 18th meeting at 95.6% probability. 125 basis point cut remains priced, pushed to September 2026. 3 simultaneous headwinds. Dollar up, yields up. Rate cuts pushed further out. Each one of those, in isolation, is a mechanical headwind for dollar-denominated gold. All three together explain precisely why $200 of war premium has unwound in 13 days, despite the conflict continuing. The Shanghai Gold Exchange benchmark is currently trading near COMEX parity in USD converted terms. That is a notable shift from Q4 2025, when Chinese central bank and institutional buying was running at record pace with visible SGE premiums above COMEX. The rate of Chinese physical gold accumulation at premium levels is not accelerating. It is compressing toward parity. The data is doing the talking. The ones who said Chinese demand would be the permanent floor, they are watching that thesis get tested in real time. And here is what makes that picture even harder to ignore. Silver's SGE premium is still running at $4 to $8 per ounce above COMEX spot. Gold parity. Silver premium. That divergence between the two metals inside the same physical demand ecosystem in Shanghai is a structural signal. It tells you physical silver demand in China remains tight, while physical gold demand has normalized from its Q4 extreme. At the same time, COMEX silver registered stocks have declined 23.1% in 30 days, with the coverage ratio sitting at 13.6%. Gold's COMEX structure shows no comparable stress. That is not a contradiction. That is the setup. Two metals, two completely different structural pictures. And before anyone takes the silver stress signal as an immediate green light, setups take time. The structural picture and the timing are completely separate questions. Anyone who claims to know the timing is selling something. Now the Iran war, because this is no longer a backdrop variable. It is the primary pricing mechanism for everything in this video. Here is the number most people are not talking about. Approximately 21 million barrels of oil per day flow through the Strait of Hormuz. That is roughly 20% of global daily oil supply through a single choke point. The International Energy Agency has approved a release of 400 million barrels from strategic reserves, its largest coordinated release in history. Oil is currently trading near $88 to $90 per barrel. The Fed meets in 5 days. U.S. GDP second estimate, University of Michigan 5-year inflation expectations, and JOLTS job openings data are all printing today, March 13th. Any surprise in those numbers sets the tone for Sunday evening futures pricing before Asian markets open. When markets fully price the reality of sustained $90 oil against a Fed that cannot cut because of inflation, gold reprices upward on the inflation hedge narrative. The dollar reprices upward on safe haven demand, and those two forces stay in direct conflict until one breaks. That is the historical pattern every time a major geopolitical supply shock has intersected with a tightening rate environment. It has not been different yet. Gold Western spot at $5,092. Intraday range today, $5,072 to $5,128. Shanghai Gold Exchange near COMEX parity. No material USD premium on gold today. Silver Western spot at 86.32s. COMEX front month silver futures at 86.96, down 2.94% this session. Shanghai physical silver at a $4 to $8 per ounce structural premium over COMEX, driven by China's mandatory 13% V8 on silver imports and restricted export licensing. The short-term picture is binary, and it resolves on March 18th. If the Fed's dot plot on March 18th signals dovish accommodation, acknowledging growth risk from the Iran conflict, gold rebids toward $5,200 and the war premium begins rebuilding. If the dot plot removes the September cut and signals concern about oil-driven inflation running longer, gold tests $5,000 psychological support and silver tests $80. That is the only short-term framework that matters right now. As for trading it, I cannot see a clean picture on the lower time frames going into a weekend with an unresolved war and a Fed meeting 5 days out. I cannot tell you what gold does Monday morning. Nobody can. If you think you know, good for you. This is a binary event environment with a weekend gap risk sitting on top of it. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY at 100.17 is a direct mechanical headwind, the strongest dollar reading in this conflict cycle. The 10-year yield at 4.24%, a 5-week high, increases the real cost of holding non-yielding bullion against yielding treasuries. The IEA's 400 million barrel strategic reserve release, if successful in capping oil at current levels, removes the inflation premium bid from gold pricing entirely. The bull case is equally real. Gold is up over 22% year-to-date before the Iran conflict began. The structural, institutional, and central bank bid predates this war. The SGE-COMEX premium divergence, gold at parity, silver at $4 to $8 premium, signals that physical demand pressure has rotated to silver, not disappeared, and historically that rotation precedes a gold re-acceleration. JP Morgan's published year-end 2026 target is $6,300 per ounce. Deutsche Bank's published target is $6,000, both from institutions with direct order flow visibility that retail does not have access to. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Here is the single most important thing this entire video points to. Gold gave back $200 in 13 days, while the war that caused that $200 move is still active. That is not a bear market signal. That is a compression event. Compressions resolve. The ones running the OG John AG 1.0 playbook understand the difference between a reversal and a coil. Don't take my word for it. Verify every number I gave you today. Check the CME FedWatch tool at cmegroup.com. Check the U.S. Treasury yield curve at home.treasury.gov. Check the ICE dollar index at theice.com. Logic over hype. Always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones who verify, don't argue about it. OG John AG 1.0, out.